General Electric CEO Larry Culp expressed optimism about the rebound in jet engine orders, noting that aerospace organic sales increased by 25% in the first quarter. He highlighted the unprecedented demand environment, which benefits both new engine production and aftermarket support for existing fleets. However, Culp also announced that GE plans to shift some production abroad following new tariffs imposed by the US government and retaliatory tariffs from trade partners. These tariffs have increased costs for both exporting from the US and importing materials, making domestic manufacturing less competitive. The announcement caused concern across financial markets, labor groups, and government officials as GE, a long-standing symbol of American industrial strength, signaled that the current trade policies are challenging its ability to maintain domestic operations. This marked a significant decision for the company to relocate manufacturing to countries with more favorable economic conditions. GE's executive team had spent months evaluating the impact of tariffs on steel, aluminum, and various imported components. While the tariffs aimed to protect domestic industries, they also drove up input costs. At the same time, retaliatory tariffs on American exports reduced demand for GE's products worldwide, including turbines, medical imaging devices, and aircraft engines. Culp and his leadership team conducted thorough scenario planning, considering all possible tariff escalations and responses. They examined domestic cost-cutting options, such as automation and labor contract renegotiations, but found these measures insufficient to offset rising expenses. The board grew increasingly concerned about projected declines in profit margins, which were already pressured by shifts in energy markets and investments in digital transformation. Recognizing the risks of sustaining high-cost US manufacturing facilities, Culp concluded that relocating some operations was necessary to preserve GE's global competitiveness. Shortly after the president's tariff announcement, Culp addressed senior managers, detailing plans to gradually close several manufacturing plants in the Midwest and Northeast. Concurrently, GE would expand or establish new facilities in Mexico, Eastern Europe, and Southeast Asia. He clarified that GE would continue to sell and service its products in the US, but production would be strategically moved to locations with lower costs. Data showed that producing abroad could reduce costs by 15 to 20% per unit under the new tariff environment. The announcement met strong opposition from labor leaders, who condemned the move as a betrayal of GE's commitments to American workers and communities. Employees responded with shock and concern, raising questions about severance, retraining, and relocation support. Culp promised a comprehensive assistance package, including enhanced unemployment benefits, job placement programs, and funding for local economic development. Despite these efforts, workers faced a deep sense of loss after years of dedication to the company. Social media and local news outlets documented the closures, highlighting the impact on factory towns. The White House shifted its messaging from initial resistance to expressing regret while defending tariffs as necessary for protecting American jobs. Nevertheless, GE's decision to move manufacturing overseas challenged the administration's narrative as it involved transferring high-skilled jobs out of the country. Because of policies aimed at strengthening domestic manufacturing, congressional leaders from both parties responded to the crisis. Democrats criticized the tariffs as economically risky and politically driven, while some Republicans privately worried that the situation revealed the limits of protectionism in an interconnected global economy. Investor circles, by contrast, reacted with a mix of relief and skepticism. Equity analysts initially downgraded GE's stock, predicting short-term share price declines due to restructuring costs, plant closures, and one-time asset write-downs. However, many acknowledged that long-term profit margins could improve once the transition was complete, especially if the company achieved greater operational efficiency abroad. Hedge funds and institutional investors circulated memos suggesting that GE's decision might trigger a broader wave of corporate relocations, as other manufacturers reconsidered the risks of retaliatory trade measures. Commodity traders anticipated changes in global steel and aluminum flows, envisioning new trade routes stretching from Chinese mills to Mexican assembly lines. The immediate effects extended beyond GE's own finances. Suppliers across the company's value chain faced sudden order cancellations and contract revisions. Smaller firms that relied on GE's US plants struggled to find alternative customers or to adapt their operations for foreign markets. Machinery, robotics lines, and specialized tooling once used in American factories faced either relocation or obsolescence. Local chambers of commerce began appealing to state governors and legislators for tax breaks and grants to preserve remaining domestic industrial activity. Municipal economists warned of shrinking property tax bases and the potential weakening of public services funded by manufacturing revenues. Conversely, regions set to receive the relocated GE operations prepared to capitalize on the opportunity. Mexican industrial parks promoted their competitive labor costs, proximity to US markets under the North American trade framework, and improving infrastructure. Eastern European countries highlighted skilled workforces and EU trade benefits, while Southeast Asian nations emphasized favorable investment incentives and access to growing regional demand. Each government weighed the benefits of hosting GE against strategic concerns raised by deeper ties to a major US corporation, balancing environmental standards, wage expectations, and local political pressures while pursuing the promise of new jobs and technology transfers. The wider manufacturing community watched these developments with concern. For decades, reshoring had attracted policymakers eager to rebuild US industrial capacity. GE's announcement underscored the fragility of these ambitions in the face of tit-for-tat trade conflicts and the complexity of global supply chains. CEOs of other large companies reviewed their contingency plans, stress-testing production footprints against rising tariffs and retaliatory measures. Industry associations held emergency meetings to lobby for tariff reductions or exemptions for critical sectors, arguing that national security depended on manufacturing resilience. Economists published studies warning that ongoing trade policy uncertainties could discourage future capital investment in the US, slow innovation, and undermine technological leadership historically associated with the country. Public opinion also shifted. Initially, consumers showed mixed feelings. Some accepted the need to limit foreign competition, while others feared rising prices for everyday goods. As news of GE's relocation spread, the narrative focused on the unintended consequences of protectionism. Editorials and TV commentators debated whether tariffs, instead of protecting domestic industry, had simply increased costs for both manufacturers and consumers. Products like household appliances, aviation parts, and medical devices, all sectors where GE held significant market share, came to symbolize a self-inflicted wound, costly, scarce, and produced outside the US. Meanwhile, GE's corporate communications team managed a delicate message. The company emphasized the strategic necessity of the move, presenting it as a shift toward a more agile, globally integrated manufacturing model. Press releases highlighted investment commitments in target countries and the promise of updated production technologies. Despite assurances from GE that it would continue to innovate products designed for the United States, the human impact, the loss of jobs, fractured communities, and the symbolic departure of a national industrial icon resonated deeply with the public. Financial analysts found it difficult to accurately predict the full costs of this transition. Expenses such as lease termination fees, severance packages, environmental cleanup of closed plants, and relocation costs were all significant concerns for investors. Investors found some relief in the fact that GE had built a substantial cash reserve and secured lines of credit specifically to manage the risks associated with such a major restructuring. Nevertheless, credit rating agencies placed the company under watch, highlighting risks that any problems in expanding overseas production or further escalation of trade tensions could threaten the fragile recovery under CEO Culp's leadership. This uncertainty caused bond yields on GE's debt to rise, reflecting market concerns about the scale and pace of the transformation. The effects extended into geopolitics as well. Foreign governments welcomed the increase in manufacturing jobs and technology investment as confirmation of their appeal to foreign investors. Meanwhile, US diplomats found themselves defending the contradiction of an administration promoting American strength while global companies sought stability abroad. Allies and rivals alike observed that if a company as symbolic as General Electric could be pushed to relocate due to punitive tariffs, it raised questions about America's reliability as a manufacturing partner. One immediate concern was whether the administration could maintain support for its broader trade agenda given GE's departure. Senior White House officials held crisis meetings to consider policy changes, such as exempting key industries from future tariffs, negotiating faster, tariff reductions with certain countries, or removing some tariffs altogether. However, any perceived rollback risked being seen as a weakness, potentially undermining the president's stance on trade fairness. Meanwhile, lawmakers from both parties saw political opportunity by advocating relief for displaced workers, proposing bills to fund retraining programs or provide tax incentives to domestic manufacturers. Inside GE, the mood ranged from serious determination to cautious hope. CEO Culp emphasized the company's long history of adapting, from the era of Thomas Edison to the jet age, stressing that GE had always reinvented itself in response to major changes. Still, employees faced uncertainty, and middle managers struggled with the complex process of closing operations in one country while expanding in another. Hiring and training new employees abroad brought challenges such as language differences, varying regulations, and the need to establish GE's safety standards and corporate culture from scratch. Experts offered mixed opinions. Some viewed Culp's decision as practical and forward-looking, aligning GE's costs with global competition. Others lamented the loss of domestic manufacturing capacity and questioned whether short-term financial gains justified the strategic retreat. Future business school case studies would likely analyze this as a cautionary example of how political ambitions, tariff conflicts, and global supply chain complexities forced even a major industrial leader to relocate its operations. As details of plant closures and new facilities emerged, a broader debate took shape around the goals of trade policy. Was its purpose to protect domestic jobs at any cost, or to create conditions where domestic companies could compete fairly? GE's decision suggested that tariffs alone could not answer this question. Modern manufacturing depended on carefully coordinated, geographically dispersed production networks, and disrupting any part of this network had significant costs, affecting suppliers, transportation systems, and consumers. Executives across the US took note. The GE case highlighted the complex balance required in supply chain strategy and the critical importance of contingency planning. Manufacturing had moved away from isolated national operations toward agile, cross-border cooperation. Tariff barriers, while politically appealing, risked breaking the connections essential to global industrial efficiency. For startups and small manufacturers, this episode foreshadowed increased challenges to entering domestic production as scale and integration became more critical.